Good afternoon and welcome to the Noble Capital Markets Virtual Equity Conference. I am Joe Gomes, Managing Director and Research Analyst at Noble Capital. Today I have the pleasure of introducing Resources Connection, a company I cover on the research side. Following the presentation, we will have some time for Q&A. Feel free to submit questions using the Submit a Question function. With us today from Resources Connection is Kate Duchesne, CEO, and Jennifer Ryu, CFO. With that, I'm going to turn it over to the company. The floor is yours, Kate.
Okay, thank you so much, Joe, and we're happy to be here at the Noble Conference. Thank you very much. I am not Christina. If you see the name in my Zoom, I am Kate Duchesne. I've been the CEO of RGP, which is our operating name, for the last 8 years, and with me is Jen Ryu, our CFO. So we'll both be taking parts of this presentation to share information about our company, and we appreciate you being here. The next slide, I hope it will advance. Hang on a minute. There we go. Yeah, is our general forward-looking statement admonition. I won't read it to you. Now I'd like to introduce RGP in a nutshell. Our ticker symbol is RGP. If you remember our company, remember really great people. We are a global professional services firm. We're built with 3 different capabilities that I'll talk about in a minute. We're traded on NASDAQ. We do have a global footprint. 80% of our business is here in North America, but we have robust practices both in Europe and Asia Pacific. The firm was started back in 1996 to bring more flexibility and a different way of working to professional services. We spun out of one of the big 4 and really created a model that in many respects was before its time, bringing flexibility and project orientation to professional services work. You know, fast forward to today, and certainly fast forward through a global pandemic, and we think our business model is perfectly aligned to both the demand trends in our client base, but also the supply trends of what talent today wants in terms of how to work, where to work, and when to work. We work within a client base that is largely Fortune 500 and beyond. We are working in our clients both on operational improvement, operational excellence, and core operational projects, but we are increasingly also working on transformation projects. In today's environment, many of those are focused on digital transformation. Think about how companies are trying to increase digital workflows, whether that's for internal workflow or how companies engage digitally with their customers or clients. That's the kind of work we can support, along with increased automation, cloud migration, preparation for AI coming into functional workflows. Those are all opportunities and the kind of work that we're doing within our client base. As I mentioned before, the talent trends are turning in our favor too. It used to be harder to convince professionals to work in a more flexible way. And if you think about where we started, it was largely harnessing the talent set of women who had fallen out of the big 4, couldn't find their way back into that traditional partnership model, still had wonderful skill sets, highly accomplished talent, but talent that wanted to work in a different way. And now we find that the rest of the world is catching up to us. If you look at labor trends and labor studies, increasingly professionals say they want more flexibility, they want more choice, and they want more control over their professional careers and development. And that is something that our model offers. In terms of what clients are doing, we really see an increase in what we call the blended workforce or the dynamic workforce model. That means that clients also coming out of the pandemic realize that they don't need to own full-time all of the skill sets or talent they need. They need to reassess what is full-time and core, and then what do they insource during peak periods, during special projects. And clients trust us as their partner to provide experienced professional talent to blend into their own FTE workforce to create the impact that they desire. We've been recognized several years in a row. We're proud of this. We talked to our potential consultants about this, but we've been recognized by Forbes as both America's best management consulting firms and mid-size employers. This slide really captures our investment highlights. I've covered many of them. The first is that the macro trends driving both supply and demand curves favor our model. Again, clients don't want to build up an entire FTE structure anymore, but recognize there are better ways to get work done. There was a great article in the May-June issue of Harvard Business Review that highlights this trend of blended workforce building with some of the largest clients. And the title of the article is "Professionals Are Coming for Your Work, but Not Your Job." And it really tells you what's happening in this environment. We have an extensive global client base that is very sticky to us. We retain our clients year after year. And while we don't sign long-term clients, we do have reoccurring work with this same client set year over year as they turn to us for their project execution. We've achieved foundational operational efficiency. And, before we saw this latest downturn in the macro environment, we were achieving mid-teen EBITDA performance, and that's our goal. We stated it at our last investor call, and we're working hard to get back there. It's been challenged because top line has been challenged in this environment, but we feel that we are very disciplined on our cost structure. And certainly in our on-demand business, 70% of our cost structure is variable, meaning that our consultants in the on-demand business are paid when they are working. They are not paid their salary and hourly rates when they are not. And that gives us a lot of flexibility financially, both to price attractively for our engagements, but also to ensure that our cost structure is in line with our opportunity. This also creates a very pristine balance sheet and substantial flexibility. We have incredible, robust free cash flow generation, which supports a reliable return of capital to our shareholders, including our industry-leading dividend, cash repurchase program, or a stock repurchase program, and the ability to do some M&A when we find the right assets. Historically, it's been more of a tuck-in strategy, but we have very strong cash on the balance sheet today. The consulting industry, I mentioned before, we're doing a lot more in the digital transformation arena. We bought a business in 2019 called Veracity, which was based in Richmond, Virginia, that is very focused on soup to nuts digital transformation. What makes that organization unique is that it blends both the human-centered design and customer, client, employee experience lens with digital development. So it's both design and technical development. And now, combining with RGP, we've also added domain or functional expertise to that kind of consulting work, which is an incredibly differentiated combination of skill sets to bring to bear on behalf of our clients. And we're excited about this category because of the growth potential in the market. That market is growing and is reflecting a compound annual growth rate, in the mid-20s, which we now have the ability to capture. As I said before, we support the project economy. 20, 25 years ago, large organizations had one project, enterprise project at a time, based upon recent research, and certainly that we've done, but also research in the macro environment. Today, large organizations have on average 20 projects of $1 million or more happening simultaneously. That means that often clients lack the expertise or the bandwidth to do it all alone, and increasingly are turning to trusted providers like us for support. This is RGP by the numbers. You can see we're very proud of the client base we have and the number of MSAs we have to do business. If you've gone through any of these cycles in the past, vendor rationalization has been a trend, and for us to be able to maintain that level of MSAs, it's one of our greatest assets in the firm, is that we have the ability to do business around the world with some of the world's most beloved brands. You can see where we break down in terms of our support for the Fortune 100 and the Fortune 500. Those numbers are not bigger, only because there have been mergers. We rarely lose a client. In fact, I've been here 25 years. It'll be 25 years in December, and I can't recall really where we've lost a client in a situation that wasn't a merger. And our clients over the past 5 years have been very sticky with us. We serve clients around the globe. A key differentiator for our model versus the Big Four is that we work as one enterprise. We are not a collection of partnerships. And therefore, what we hear from our clients is that speed to impact is greater. We're easier to work with. We can connect dots as a united team, which provides benefit to our clients in ways that competitors cannot. Coming out of the global pandemic, we've also learned how to really run borderless employees, meaning that we can combine skill sets to deliver on projects, no matter where that intellectual capital sits in the world. And we've been able to do that because we've made investment in our own technology infrastructure to deliver on behalf of our clients. If you've covered any of our recent earnings calls, we've talked about building centers of excellence for both finance and accounting talent and technical talent in both Manila and India. And that allows us to compete with the Big Four, who have built teams in those locations earlier than we did, but it allows us to blend teams, to blend rates, and therefore deliver value to our clients. Our average tenure, and this is something I like to highlight, is at 5 years now. We say we brought flexibility and agility to professional services in the late 1990s. It really wasn't until more recently, certainly in the 2000s, that the macro environment seems to have caught up with this strategy, which is to say, you don't need to own all of the talent you need full time. You just need a trusted partner to be able to support you, and we are that trusted partner. Many of our consultants come from employee referrals, which tells us this stat has been high for the last 20 years. Consultants like working in our model and therefore refer others into our model. And the last thing I'll say on this page is we're very proud of our diversity in the organization. We are much more diverse than the Big Four that we compete against. And we think, again, that creates better value and better experience for our client base. There are many ways to creatively solve problems, and by bringing a more diverse set of talent together, we think we have a greater opportunity to do that. These have been our enterprise growth drivers for the past fiscal year. Remember, our fiscal year starts at the beginning of June, so we've just launched into our fiscal year 25. These growth drivers will evolve, and we'll be talking about that at our next earnings call, which is in mid-July. But primarily, we've been focused on continuing to transform digitally, not only by bringing more efficiency and scale into our own business, but also creating a better experience for our stakeholders. We've been working on brand clarity, and you'll hear more about that in our next earnings call. We've been evolving our operating model to ensure it's aligned to deliver on the strategy that we have in place at the firm, which is to create a more diversified portfolio of capability with both on-demand consulting and outsourced services. We've been focused on enhancing pricing as a growth driver. You know, in North America, for example, our average bill rate is about $160 an hour. When we're competing against the Big Four, which has a blended rate in the mid 200s or higher, we are an incredible value proposition for very similar talent, if not better talent, because unlike the Big Four, we don't deploy first, second, third year talent that often has to learn on the client's dime. We are an experienced hire model, so we're deploying consultants who've been there, who've been professionally trained in professional services, but also have industry expertise. And then we've been looking at M&A as an opportunity to grow. Again, that's been more of a tuck-in strategy for us. We've done 2 deals. One is about to close this past fiscal year, one in the digital transformation space, and the other in financial services, bringing more management consulting capability in financial services. This is a new slide that we've put in that hopefully gives our investors and interested parties a better sense of what is our advantage and what do we do. As I said before, we offer on-demand talent. That's been our core. That was our heritage. We've added consulting capability focused on digital and functional or domain expertise. And then we have an outsourced business, services business, that focuses on startups, scale-ups, and carve-outs for clients who don't want to build their own finance and accounting infrastructure, but want to outsource those functions, again, to a reliable partner. And that's been an exciting, growing part of our business. On the right-hand side, you can get a sense of who are our core buyers, the core industries we serve, our core capabilities, and our core regions of operation. With that, I'm going to hand it over to Jen to cover our capital allocation and some further financial information.
Sure, thanks, Kate. So as Kate mentioned earlier, I mean, RGP has had a track record of generating strong operating cash flow. And with little maintenance capital, the free cash flow affords us the ability to invest in our future and deleverage quickly if needed, and as well as providing returns to our shareholders. Our focus right now in terms of capital deployment is really investing growth, both organically as well as through strategic acquisitions. Kate provided some color on our M&A focus areas. And, you know, we typically carry little to no debt. And if we do, as I said, we can deleverage very, very quickly. Our shareholder return comes in the form of both dividends and share repurchases. We have typically taken a more opportunistic approach to share repurchases, but have been very, very consistent on our quarterly dividends. If we can move to the next slide. Kate, we move to the next slide.
Sorry. Yeah. Sorry.
This just gives you a little bit of a feel for just how much shareholder value we've returned over the last 5 years: 52 million in share repurchases and 91 million of dividends. And as Kate mentioned earlier, we've typically had industry-leading dividend yield historically, and we've been consistent with our dividend return over the last 10 years. And with that, I think we're ready for some questions.
Great presentation, Kate and Jen. Thanks for that. Let me start off the Q&A right from the audience. Your gross margin has trended down over the past few quarters. Should we view the current 39% level as stable state, or do you expect this to move lower?
I can take that one. I mean, what really drives our gross margin? I would say three things, right? One is our pay bill spread. Two is we do carry some fixed cost, and not a lot, but you know, we do pay our consultants, right? Obviously benefits. So as if they sit on the bench, even though we pay them when they are billable, but there's still some fixed costs related to that. So as top line fluctuates, it definitely has some impact on gross margin. And the third factor impacting our gross margin is mix. And so over the last few quarters, I would say that our bill pay spread has stayed very consistent. We're still doing a great job in raising our bill rates and in each region. So that's not what's impacted. So over the last probably couple of quarters, fixed costs, obviously with top line being down, definitely has an impact on gross margin. The biggest thing driving gross margin down in the last few quarters is our mix. Our revenue mix has shifted from North America, who typically has much higher gross margin, to international regions, who typically is a little, their gross margin is a little bit lower. I expect that this trend is going to reverse as we start to see meaningful recovery of top line in North America. So I don't think it's going to go any lower, because I do think that where we are right now, we've starting to see revenue mix and the business overall starting to stabilize over the last couple of quarters. So I actually expect our gross margin to improve, as the cycle start to become more normalized.
So that leads right into the next question from the audience. Impressive retention of enterprise clients. Given RGP revenue trends, your clients have clearly cut back on spending. Are you seeing any evidence of this trend that might inflect positively?
Yeah, I would say yes, but we're cautiously optimistic. So, what we've done an excellent job at is extending our consultants during this downturn. So that tells me that our clients really value our talent and they don't want to let go. But what we didn't see this past and it really happened about this time last year, where we started to see clients really start pushing off projects, or even if they started them, they would chunk them into pieces because budgets were getting tight and everybody was thinking, should we deploy capital now, or are we going into recession, et cetera. So what we didn't see this past year that we're starting to see happen now is new project starts, talking to clients about getting budget, getting assessments going, getting to the start of projects. So we're cautiously optimistic that the green shoots are emerging.
Okay, thank you for that. And again, kind of a follow-up to that, as the cycle improves, which of your businesses are you most excited about? Which do you think has the opportunity to reach new heights in the next upcycle?
Well, I'm excited about all parts of our business. So if you think about our business in on-demand consulting and outsourced services, I talked to the leader of our outsourced services business, and she said, I've never been this busy. So that aligns with client conversations we've been having around what are the outsourcing opportunities now? And I think businesses today, because of talent shortages, because of retention challenges, are saying, what do I need to keep inside my organization and what can I let go? So I think outsourcing is coming back into the forefront. This is a cycle that we've seen before, but seems to be coming back. I think our approach is different because it's very bespoke. I'd encourage any investors who want to learn more about that part of our business to go to www.countsy.com and really see what we're doing there. It's a very technology forward, but people supported business model that I love. So we're excited about that. I'm excited about consulting. As I said before in the presentation, bringing together digital, but both design and human-centered experience, bringing that together with domain expertise is a really differentiated offering. So if you think about like ServiceNow as a software platform, and we're an elite partner globally for ServiceNow, what they're trying to do in their client base is digitize workflows as it relates to all functional areas. But in order to do that in the right way, you need somebody in the room with you who understands that function or domain. Many ServiceNow providers don't do that. They know the product, but they don't know the domain. And we do. We bring both together. That makes me very excited for the future, as we really have done a lot this year to organize our consulting division to deliver growth.
Are there any regulatory or technology drivers now in the future that could provide a lift to the business, such as ERP cloud migration or Oracle cloud migration?
Yeah, the short answer is yes. I mean, we just closed a multi-million-dollar piece of business with a brand name retailer, where we're helping them with their S/4HANA migration. But we're also supporting clients with the Oracle Fusion, and that work will go on because many of the clients are behind in terms of their strategies, and these large ERP providers have declared that on-premise support is going away. Now, those dates have been moved a little bit because of the global pandemic, but everyone's going to have to go to the cloud. It's just a matter of how fast and when, and there's a ton of work out there to get organizations both ready and implemented and then steady on the other side of migration.
So you mentioned the various uses of cash flow, and one of them was M&A. So, what is the appetite for acquisitions right now? Is there a pipeline to speak of? What types of gaps, if any, are you trying to fill?
Yeah, sure. I can take that. And yeah, I mean, we are actively looking at deals and have a pretty healthy pipeline that we're working through. And really, the areas that we want to expand is, we're going to use M&A to bringing additional capabilities or add or something that's complementary to our existing capabilities to add scale. And also in terms of geographic expansion. So for example, we just did the CloudGo deal, and that is a ServiceNow firm that's based, in Singapore. And that's really to scale and, our geographic presence, scale and expand our geographic presence for our Veracity business, who is also a ServiceNow implementer. So just as an example. So yeah, I mean, we are, historically have looked at tuck-ins, but I think Kate may have mentioned it earlier, but we're certainly interested in bigger deals as well, to the extent that it's, it's right for the business. But we are, I would say, you want to take a measured approach to our M&A, to doing deals. And so definitely looking to make sure that, whatever we get into, it's going to be the right deal for us and our shareholders.
Okay, I'm going to sneak one more in here. How should we think about target margins in the next upcycle? Have any structural improvements occurred or cost reductions that could lift margins to new heights?
Our target margin in the next upcycle should be back to where we were in fiscal 22 and 23. As a reminder, our fiscal 22-23 margins were, were close to 13. And we've said this, at our last investor day, which is our target, our operating margin should be in the mid-teens. I think I'm confident that we should be able to get there as soon as the broader environment normalizes and our top line gets back to kind of where we were before. And we've done a lot from a cost structure standpoint, right? We've reduced a lot of fixed costs, and we're always looking at our management compensation or our internal capacity against the demand environment. And also with the technology investment that we've made, I expect that is going to help us streamline our cost even further, so that especially from a scaling perspective, as we continue to grow our top line, this technology, the new technology that we're implementing, is really going to allow us to reach higher leverage.
Great. Well, Kate and Jen, that's all the time we have for today. We really want to thank you for participating in the conference. Great presentation. Really look forward to seeing the resources connection story unfold going forward. Again, thanks again.
Thank you, Joe. Thank you all for your interest.
Bye-bye.